Hello, everyone, and welcome to today's webinar, Are Your Nonprofit Employees Still Exempt? A review of the DOL's 2024 final FLSA overtime regulation. Today's webinar is being recorded, and you'll receive a follow-up email within 24 to 48 hours with a link to view the recording and a copy of the slides. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send your questions in at any time during the presentation. We will collect these and address them at the end of the presentation. I will now turn it over to today's moderator, Eileen Johnson.
Thank you, and thank you all for joining us today. I am Eileen Johnson. I'm the co-chair of our Nonprofit and Associations Practice Group, and I'm joined today by two attorneys in our Employment and Labor Group, David Stevens, a partner in our Baltimore office, and Lisa Brauner, a partner in our New York City office. Both of these attorneys provide advice regularly to our nonprofit clients on various employment issues, and today they're going to be talking about the updates to the FLSA. We'll start with David, who'll provide an overview, and then Lisa will tell us how this affects our nonprofit organizations in particular. Take it away, David.
Great, thank you, Eileen. I'll be talking with you through the first part of our discussion today, which will focus on what has changed under the new rule that was issued by the Department of Labor and how that will affect overtime issues and most specifically exempt status for employees with respect to the Fair Labor Standards Act. I'll then turn it over to Lisa, who will be talking with you about some of the nuances of the FLSA as it relates specifically to nonprofit employers. Before we jump in, I do have to give our regular disclaimer that we're only providing general information in today's presentation. When it comes to employment law generally, and particularly the type of FLSA classification issues that we're going to be talking about, how the law applies in a particular situation involves a very factually specific analysis. And so we definitely encourage you to speak with legal counsel when you're dealing with those type of issues within a particular organization. With that, let's go ahead and get started. If we could advance to the next slide, please. We'll get started with a brief overview of the FLSA and sort of how the statute is organized. This is a law that dates back to the 1930s and sets a nationwide floor with respect to minimum wages and overtime. The numbers have changed over the years in terms of the minimum wage rate. But the basic framework of the statute is largely the same as it was when the law was enacted. Most relevant for today's discussion are the overtime requirements that are contained within the statute. The FLSA sets a baseline requirement that once an employee has worked 40 hours in a given week, the employer has to pay the employee time and a half of the employee's regular rate for all hours above 40. So to take a simple example, if there's an employee who is normally paid $20 an hour, once they hit 40 hours, they would have to be paid $30 an hour for each additional hour that they work within that work week. But while the FLSA establishes that baseline rule, it also contains a number of exemptions, with employees who fit within those exemptions being considered what we would call exempt employees who don't have to be paid overtime. The requirements that apply in order for an employee to fit within one of those exemptions are laid out in regulations that are issued by the Department of Labor. We'll be talking in more detail about some of the main exemptions as we go forward, but the main principle I want to note at the outset here is that each of the main exemptions under the FLSA generally have two elements. One is what we could refer to as the compensation element or the salary element, and then the other is what we would call the duties element or the duties test. And in order for an employee to qualify as exempt, both of those requirements have to be satisfied. And so on the duty side, what we're referring to there is that the type of work that the employee is doing has to fit within one of the exemptions that are contained in the statute, and the particular duties that the employee has to perform vary from one exemption to the next. And we'll talk about that in a little bit more detail as we move forward today. On the compensation side, the main exemptions each require that the employee be paid on a salary basis, meaning that the employee is paid the same salary for each work week, whether they work 30 hours in that week or 50 hours in the week. That's the inherent trade-off with the exemptions, is that the law is essentially saying to employers, if you want to not have to pay overtime when the employee works extra hours, you can't reduce their pay when they work fewer hours than they normally would. There are some nuances to that, but for purposes of today's presentation, that's the general rule. And in addition to paying the employee on a salary basis, the employer also has to pay the employee the salary level that meets a minimum threshold that's set by the regulations. And that's what brings us to the heart of what has changed this year as a result of the new rule that was issued by the Department of Labor. Can we go ahead to the next slide, please? As you can see from the slide, this new rule took effect on July 1st of this year. And the core piece of what the new rule has done is to increase the salary threshold that an employee has to be paid in order to qualify for the white collar exemptions under the FLSA from $684 per week up to $844 a week. And on an annualized basis, that's an increase of a little more than $8,000 from the prior figure of $35,568 per year up to $43,888 per year. The rule also increases the salary threshold to qualify for what's known as the highly compensated employee exemption, which we'll talk about a little bit later, from $107,964 to $132,964. So that's an increase of $25,000 per year, obviously pretty substantial jump. The other major takeaway from the new rule is that this is not a one-time increase. The rule builds in an additional increase that will take effect on January 1st of 2025, which is actually larger than the increase that took effect on July 1st. Effective as of January 1st of next year, the salary threshold for the white collar exemptions will increase to $1,128 per week, which equates to $58,656 per year. So that means that from January 1 of this year to January 1 of next year, the total salary increase for the primary exemptions is going to be just over $23,000. So very significant jump. One result of that is that employers who have employees who are below that upcoming threshold of $58,656 in terms of annual salary are going to be faced with a choice of either increasing the employee's pay up to that new level or reclassifying the employee from exempt to non-exempt. That's likely going to involve some individualized assessments in terms of how close an employee's pay is to the new threshold and how much of a benefit the organization believes it would likely realize from maintaining the exemption. Just to kind of give a couple examples from the two opposite ends of the spectrum so you can hopefully get a flavor for what that consideration would look like. Let's say you had an employee whose current salary is $55,000 and they regularly work 50 hours a week. Well, it's almost certainly going to be less expensive to increase their salary marginally to get them up over that new threshold rather than lose the exemption and begin paying them time and a half for those 10 hours of overtime that they would otherwise have to be paid each week if they were not an exempt employee. On the other hand, if you have an employee who's currently exempt, who's earning $45,000 a year and they're only occasionally working outside of a normal 9-to-5 schedule, converting that employee to non-exempt and paying those occasional overtime costs may be more attractive than giving the employee a $13,000 raise to get them up above that new salary threshold. And obviously within that spectrum, employers are likely going to have to engage in some case-by-case assessments of what they think the best course of action is with regard to a particular employee. The other thing I'll note about the upcoming January 1st change is that the salary threshold for highly compensated employees and that exemption will also be increasing up to $151,164, a similarly large jump relative to where it stood at the beginning of this year. And then as a final note on just the overall framework of how this new salary level adjustment is going to work, there will be periodic adjustments every few years going forward, with those increases tied to national earnings data based on a formula that's built into the new regulation. Can we go ahead to the next slide, please? So the main change that is instituted by this new rule is that the salary levels that have to be paid in order to qualify for those exemptions is being increased. However, I do want to make sure that I'm clear in communicating that simply paying an employee a salary that meets that minimum level is not enough by itself to render the employee exempt. This goes back to what I mentioned earlier, there being two components to the test for exempt status, the salary test and then the duties test. The duties test has not been changed by the new rule, so the traditional elements of that test will still apply. I did think it would be worthwhile, though, just to sort of touch on the various main exemptions and what's required under the various duties tests that each of those exemptions has, just as a way of sort of refreshing everyone on that as you're looking at these issues moving forward with the change in the salary levels. So the main three, what we call the white collar exemptions, are the executive, administrative, and professional exemptions. To qualify under the executive exemption, the employee's primary duty must be managing the business or some department or subdivision of business. The employee also must regularly direct the work of at least 2 full-time employees or a combination of part-time employees that adds up to 2 full-time equivalents. So it could be an employee managing 2 people who are working 40 hours a week, or it could be the employee working 4 people who are each working 20 hours a week, but there have to be that 2 full-time equivalents that are being supervised. And so if the employee, even if they're operating in that type of executive function, but they're not actually either directly supervising someone, or if they're not operating in a way where they have hiring and firing authority, or at a minimum the ability to effectively recommend changes when it comes to hiring, firing, promotions, or other type of employment decisions, the employee can't qualify for that executive exemption. So as you can tell, it's a multi-factor test that's very fact intensive in terms of looking at what that one particular employee is doing. That's a common theme with many of the FLSA exemptions, which is a frequent source of heartburn for employers. It's very easy to envision how you could have 2 people who are working at different organizations, and they may have the same job title, but depending on what their actual authority and duties are, one may be exempt and one may be non-exempt. You can't go by the job titles alone. That's particularly true with regard to the next exemption, the administrative exemption. To qualify for that exemption, the employee's primary duty must involve the performance of office work that directly relates to the management or general operations of the employer, as opposed to, for example, producing the product. So you think of your accounting functions, your HR functions, marketing, any of those, what we might loosely call sort of back office type of roles, are typically what you're looking at when you're looking at the administrative exemption. Additionally, though, and this is where the devil is often in the details, the employee's primary duty has to involve the exercise of discretion and independent judgment with regard to matters of significance. And in essence, what that means is that it's not enough to work in a role that relates to those back office operations. The employee must also be operating at a level that involves some real decision-making authority. So to just kind of take a simple example, it's the difference between someone who's a CFO and then someone who's a junior accounting clerk. One is exercising some significant authority and decision making, and the other one may just be entering data in sort of a more junior role. And so that's where that distinction comes in as far as who can qualify and who would not. The third of the big 3 exemptions is the professional exemption, and that's essentially 2 exemptions in one. Is there are different standards for what are known as learned professionals and creative professionals. A learned professional is someone who has a primary duty that consists of work that requires advanced learning in some field of science or learning, that's intellectual in nature and that requires the consistent exercise of discretion and judgment. So your classic example there would be an engineer or a research scientist. Well, on the other hand, a creative professional is someone who has a role that involves work that requires invention, imagination, originality, or creativity in some field of artistic endeavor. That could be a writer who's, creating advertising. It could be an artist. It could be a musician. And again, sort of the level of discretion or sort of authority that person is exercising can be a significant factor in whether or not a particular employee will qualify for those exemptions. And so, as you can tell, the determination of whether someone qualifies for one of these exemptions can be relatively difficult. I mean, there are going to be some positions for which it's generally obvious that someone qualifies, but there are many roles that are somewhat close to the line. One of the things that was intended to make the issue a bit simpler for employers is what's known as the highly compensated employee exemption, the last one on our slide here. The thought process behind that is that if an employee is earning at a high enough level in terms of their salary, it's considered to be likely that they're performing the type of work that would qualify as traditionally exempt. So as a result, employees who are paid above a certain salary threshold, this is the heightened threshold that's just recently moved from a little over $107,000 up to $132,964, those employees are subject to a less complicated duties test. In essence, if the employee is paid over that threshold and they're performing office work that involves at least one of the exempt duties of an administrative, executive, or professional employee, they'll be considered exempt. So just to recap here, the duties tests are not changing as a result of the new rule, but an employee still has to fit within one of the defined exemptions in order to be exempt from the overtime pay requirement, even if they're paid at a salary that exceeds the new salary thresholds. Can we go on to the next slide, please? This next slide makes an important point, which is that while the FLSA, which again is a federal statute, sets a baseline, states are free to set their own employment standards. If a higher standard applies in the state where the employee is working, then the employer needs to comply with that state standard as well and pay whatever that higher rate may be in order to maintain the exempt status. If you meet the federal standard but not the applicable state standard, you won't get sued under the federal law, but that won't be much comfort if you're then sued under the state law. So as you can see from this slide, New York is one state that sets a higher salary threshold to qualify for an exemption than the FLSA does. Also, just to kind of complicate things a little bit further, New York applies a different salary threshold to workers who are in New York City and certain surrounding counties than to employees in other parts of the state. Meanwhile, as you can see from the slide, if you're around the DC metro area, the relevant jurisdictions there do follow the FLSA in terms of what standards have to be met for the employee to qualify as exempt. Can we go on to the next slide? One point that there has been some confusion about with the new rule relates to the minimum wage. The minimum wage number under the FLSA, as opposed to the salary level for exempt status, has not changed as a result of the new rule. The FLSA minimum wage is still $7.25 per hour, which has not changed for roughly the past 20 years. However, as I mentioned earlier, the federal statute sets a floor, and states and local jurisdictions are generally free to set their own minimum wage. So if you're employing someone in a state that has a higher minimum wage, you will need to comply with that higher requirement. Next slide, please. So the final issue that I'll be talking with you about today before I turn things over to Lisa concerns the question of who's covered by the Fair Labor Standards Act. The law is written in such a way that it sets a relatively low bar for who's going to be subject to the minimum wage and overtime requirements. At an overall level, there are two ways that a worker can become subject to the FLSA. There's what's known as enterprise coverage, which means that the employer itself is covered at an entity level. And then there's individual coverage, which means that the nature of the employee's own work triggers coverage under the law. In terms of enterprise coverage, an entity is covered by the FLSA if it's engaged in commerce or in the production of goods for commerce. Now, the way that that's defined by statute is that an employer is considered to be engaged in commerce if it has at least 2 employees who handle, sell, or otherwise work on materials that have been moved in commerce or produced in commerce, as long as the employer also has an annual volume of business of at least $500,000. So as you can imagine, given the way that just about everything that an employee works with, from computers to machines or equipment, has moved across state lines at some point, that essentially boils down to a standard that if the employer has at least 2 employees and generates at least $500,000 in revenue, it will typically be considered a covered enterprise. There are some significant nuances when it comes to nonprofit entities, which Lisa will be discussing with you in a lot more detail, but that's the basic standard for private enterprises. I should also note, as you can see in the slide, that there are certain types of enterprises that are automatically covered regardless of their revenue, specifically hospitals, residential healthcare facilities, and educational institutions. Can we go on to the next slide? The other way that a worker can become subject to the requirements of the FLSA is through the nature of the employee's own activities on behalf of their employer. That can be the case if the employee is individually engaged in interstate commerce, or if the employee is working in a role that is directly involved in producing goods that will be sold in interstate commerce. Again, the way that this tends to get interpreted, particularly given our interconnected world these days, it ends up being a relatively low hurdle to clear. For example, if the employee has a role that involves making out-of-state phone calls or sending materials out of state or transporting property out of state, that will typically get over the threshold to qualify for individual coverage. To give just one example, the Department of Labor takes the position that an employee whose job involves typing a letter that then gets mailed out of state will be involved in commerce for purposes of the law. Again, this is typically going to be a standard that's relatively easy to meet, again, subject to some of those nuances that apply specifically to employers in the nonprofit sector. So now that we've covered the basics of what has changed as a result of this new rule and sort of how coverage generally operates under the FLSA, I'll go ahead and turn it over to Lisa to give some more detail on the specific considerations for nonprofit employers.
Thank you, David. Okay, so we're going to talk about how the rule and the FLSA now apply to nonprofits, which apply in an interesting and different way than they do to for-profits in some respects. Next slide, please. So with respect to enterprise coverage, as David mentioned, there are 2 types of ways in which there can be coverage under the FLSA, either enterprise coverage or individual coverage. Enterprise coverage, as David mentioned, is where an entity has annual gross volume of sales or revenue of at least $500,000. When it comes to nonprofits, however, this refers to only commercial activity conducted by a nonprofit organization. Not every nonprofit organization engages in commercial activity, as you know. But with respect to those that do, the threshold is if their annual revenue, commercial revenue, is at least $500,000 a year. Income from donations and membership fees and furtherance of charitable activities don't count towards that number. Next slide, please. In determining whether a nonprofit organization is a covered enterprise under the FLSA, the Department of Labor's Wage and Hour Division will consider only activities that are performed for a business purpose, but not the charitable activities performed by the nonprofit. So charitable, religious, educational, or similar activities of organizations that are operated on a nonprofit basis where those activities are not in substantial competition with other businesses do not result in those organizations being considered covered enterprises under the FLSA. The nonprofit organizations are generally not covered by the FLSA on an enterprise basis unless they engage in ordinary commercial activities that result in them doing business for a business purpose. And a nonprofit organization can have enterprise coverage, but not individual coverage, if it meets the threshold of at least $500,000 annually and is engaged in commerce or the production of goods for commerce, but doesn't employ any workers who are individually engaged in interstate commerce or the production of goods for interstate commerce. And I'm going to be talking about a few cases that address this issue of when a court has determined there's enterprise coverage or that there's not enterprise coverage, or when a court has determined that there's individual coverage or not for a nonprofit. So the enterprise coverage, just to clarify, applies to the entire organization and all of its employees, regardless of individual activities, if the organization meets the criteria for covered enterprise. Next slide, please. So some examples of enterprise coverage. Let's take the example of a nonprofit museum. They operate a gift shop, and the gift shop generates at least $500,000 in annual gross revenue. Or an animal shelter that operates a veterinary clinic providing veterinary services for a fee, which generate at least $500,000 in annual gross revenue. That there would be enterprise coverage under the FLSA. And it's the employees who are engaged in the commercial activity who are protected by the FLSA on an enterprise basis, not the employees of the organization's charitable activities. Those employees, those who are involved in the charitable activities, are not covered on an enterprise basis, since they don't have, those activities don't have a business purpose. So next slide, please. Oh wait, before I get to individual coverage, which I will get to in a moment, I did want to mention a seminal case that I had in the earlier slide when I was talking about enterprise coverage. And that case was the slide just before that, the Tony and Susan Alamo Foundation against the Secretary of Labor. But Kate, if you want to go back, yeah, there we go. Thank you. So the Tony and Susan Alamo Foundation it was a nonprofit religious organization, and among its primary purposes are to establish, conduct, and maintain an evangelistic church, to conduct religious services, to minister to the sick and needy, to care for the fatherless and rescue the fallen, and do other things to promote the Christian faith, virtue, and charity. The foundation does not solicit or did not solicit contributions from the public. It derived its income largely from the operation of a number of commercial businesses, such as service stations, retail clothing and grocery outlets, hog farms, roofing and electrical construction companies, a record-keeping company, a motel, and companies engaged in the production and distribution of candy. The businesses were largely staffed by the foundation's associates. They're referred to as associates, most of whom were drug addicts or criminals before their conversion and rehabilitation by the foundation. The workers did not receive any cash salaries, but the foundation provided them with food, clothing, shelter, and other benefits. In that case, the Supreme Court determined that the foundation was an enterprise under the FLSA because the organization's commercial activities, such as operating the service stations, the clothing stores, hog farms, etc., were found to have a substantial effect on interstate commerce. And the court said that the foundation's commercial activities undertaken with a, quote, common business purpose were not beyond the reach of the FLSA. Just because the foundation was religious in its character, its associates were still employees within the meaning of the act because they worked in contemplation of compensation. So the court held that the workers at that foundation who were receiving food and shelter for their work but not pay, that they were entitled to minimum wage and overtime protections under the FLSA. In another case, Bokemeyer against the Fourth Universalist Society in the city of New York, the court found that the church's participation in an extensive advertising campaign to solicit interstate renters for its special event space was sufficient to invoke enterprise coverage under the FLSA. So for nonprofits who have event space, something to consider that they are, if they are advertising for that space. So I want to give you also an example. I gave you some examples of instances where courts found enterprise coverage. I'd like to give you an example of a case where a court found that there was no enterprise coverage under the FLSA. In a case called Worker against Interfaith Nutrition Network, the defendant, Interfaith Nutrition Network, was a not-for-profit organization that operates soup kitchens, emergency shelters, and housing programs. It had a long-term housing program that consisted of 23 housing units, all located in New York, and the nonprofit charged tenants rent to stay in the housing units. And the plaintiffs who brought the lawsuit, the FLSA lawsuit, were maintenance workers who would do upkeep in the housing units. And they alleged that they were covered by the FLSA, specifically that the nonprofit was an enterprise covered under the FLSA. They alleged that the organization competed with other commercial landowners for these tenants. And they also alleged that the nonprofit routinely made their land and other real estate available for sale to the general public and sold this land and other real estate to the highest bidder. The court rejected the plaintiff's claim that the nonprofit was an enterprise under the FLSA simply because they, quote, routinely competed in the marketplace with other commercial enterprises. So, and another allegation that was also made was that it was a covered enterprise because it derived a substantial portion of their yearly net revenue from these and other commercial activities. But the court said these allegations failed to support a reasonable inference that the nonprofit competed in the marketplace with ordinary commercial enterprises because there were not facts in the complaint indicating the competitive nature of the nonprofit's alleged commercial activities. Specifically, the court said that the plaintiffs in that case didn't present any facts suggesting that in renting and selling its properties, the nonprofit competed in the marketplace with ordinary commercial realtors, for example, through advertising or solicitation. So that seems to be a recurring factor or element that the courts have looked at is the nonprofit advertising? Are they soliciting? Are they acting in ways that a for-profit competitor would? Are they acting in ways that make them appear that they are in fact competing? So the court said they haven't presented facts that their renting and selling properties competed with ordinary commercial realtors. The court also said that the plaintiff's conclusory allegation that the nonprofit routinely competed with other commercial enterprises provides no indication as to the actual frequency of defendants' activities. That's another factor that the courts look at. How frequently is this happening? So the court ruled that the allegations do not support a reasonable inference that the defendant provides services to the general public for which it competes with other commercial enterprises, such that it could be deemed to have entered the economic arena and trafficked in the marketplace and thus subjected itself to the standards that Congress had prescribed for the benefit of employees. So those are some factors that the courts have looked at. It's also possible for, as I mentioned, for a nonprofit enterprise to have enterprise coverage without individual coverage when the organization meets the criteria for enterprise coverage. Like there are those that are statutorily automatically covered enterprises like hospitals and schools. Next slide, please. Next slide. Okay, perfect. Thank you. So we talked about enterprise coverage, and now I want to switch to individual coverage. So even if an enterprise, even if a nonprofit as an enterprise isn't covered, its individual employees can be covered under individual coverage by virtue of whether they're regularly and directly participating in the actual movement of persons or things in interstate commerce. And the US Department of Labor had issued several years ago now, almost a decade ago, guidance for nonprofits on when there's individual coverage. So employees who regularly engage in any interstate communication, for instance, as David had mentioned earlier. So an employee who makes or receives interstate phone calls, ships materials to another state, or transports persons or property to another state is engaged in interstate commerce. An employee of a nonprofit who regularly makes phone calls to donors in other states, sends emails to out-of-state vendors, or processes donations that come from or go to other states could be individually covered under the FLSA, if this is a substantial part of their work. So employees engage in commerce for FLSA purposes when their duties require regular and recurrent telephone use, let's say for interstate communications. Also, if a nonprofit employee handles goods that have moved in or will move in out in interstate commerce, they may also be covered under individual coverage. For example, a staff member who stocks and sells books that were published out of state is likely covered under the FLSA. An employee whose job is processing credit card transactions can be subject to individual coverage because these transactions typically involve interstate banking and finance systems. So just, kind of as an overview, that the Department of Labor's interpretation of the FLSA point to broad individual coverage for employees of nonprofit organizations who engage in interstate communication. The Department of Labor will look broadly to find that an individual is covered by individual coverage. If an employee is involved in producing goods that will be moved to another state, or that will be used in producing other goods for interstate commerce, they may be individually covered. I think there was a situation with a case involving goodwill and people transporting clothing over state lines, and a finding that the individual was individually covered. Purchases from out-of-state vendors are also sufficient to invoke the protection of the FLSA unless they involve only sporadic and occasional shipment of insubstantial amounts of goods. So going back to the case that I mentioned earlier of Warco versus Interfaith Nutrition Network that rented out housing units, as I mentioned, there the court said that the plaintiff's allegations that they routinely had to make phone calls to companies located outside New York was insufficient to establish individual coverage under the FLSA. So what were the factors that the court looked at? The court said an employee engages in commerce when a substantial part of the employee's work is related to interstate commerce. The fact that these employees were saying that they routinely made calls to companies outside New York wasn't enough, because the court found they didn't articulate facts indicating that this was a substantial part of their job to be making these phone calls. So the question is, the test for individual coverage is not whether the employee's activities affect or indirectly relate to interstate commerce, but whether they are actually in or so closely related to the movement of commerce as to be part of it. So employees that engage in commerce when their duties require regular and recurrent telephone use for interstate communication, although that would constitute FLSA individual coverage. In the Walker case, the plaintiff's allegations that the phone calls were routine was just not sufficient to rise to the level of individual coverage. The court also noted that the plaintiffs failed to indicate the regularity of their phone calls or the substance and purpose of the calls, other than to say they were sometimes getting technical support. And so the court found that the complaint didn't allege facts that would support a conclusion that the use of interstate phone calls was a substantial part of their work. Plaintiffs also tried to argue that they routinely used and handled goods, equipment, and other materials like motor vehicles and hammers and screwdrivers and snow blowers, much of which were originated or manufactured in states other than New York. And the court rejected that argument and again said, to say you're doing this routinely is insufficiently vague. It doesn't provide specific information on the actual frequency of the plaintiff's alleged use of the items. And the alleged use of these items is just too marginal a relationship to constitute plaintiff's engagement in interstate commerce. They haven't indicated the frequency or the quantity of goods that they purchased from out-of-state vendors. That was another argument that they made that the court rejected. So purchases from out-of-state vendors are or can be sufficient to invoke the protection of the FLSA unless they involve only sporadic or occasional shipments of insubstantial amounts of goods. So as I mentioned, the FLSA's individual coverage is quite broad. So employees of nonprofits not covered on an enterprise basis may still be entitled to FLSA protections if their own activities meet the criteria of individual coverage. Next slide, please. I will say a caveat, which is that the U.S. Department of Labor's Wage and Hour Division has said that it won't assert that an employee who on isolated occasions spends an insubstantial amount of time performing individually covered work is individually covered by the FLSA. So again, it really needs to be a substantial amount of time or a substantial part of their job. Next slide, please. Volunteers. So I wanted to address this because it's something unique to nonprofits to be able to have volunteers. And the U.S. Department of Labor's regulations say that volunteers are not employees for FLSA purposes if certain conditions are met. First, the individual has to be offering their service freely and without coercion. They have to have no expectation or receipt of compensation. The nature of the organization they're volunteering for is important, that they're volunteering for public service, religious or humanitarian objectives, and that their intent is to volunteer, not to get compensation, and also that they are not displacing other workers. Typically, the volunteer is doing something on an intermittent or part-time basis or a one-off opportunity to volunteer, but they're not displacing the work of employees. Paid employees of a nonprofit organization may not volunteer to provide the same kinds of services to their employer that they're employed to provide. They also may not volunteer in the commercial activities of a nonprofit. They may not volunteer to work in the gift shop of a museum if they're an employee of the museum. It's also important to recognize that certain states have their own definition of what constitutes a volunteer as opposed to a trainee. The FLSA doesn't define intern, which some organizations use, but some states may define that term. So it's important to also know what the state laws are with respect to volunteers. The U.S. Department of Labor, for instance, as a volunteer may get a stipend. New York State takes the position that volunteers can be reimbursed or obtain, a stipend to reimburse them for costs associated with the volunteering. If somebody were traveling on the subway and they were, being reimbursed for the travel to get there, something like that. But states may have, that's just to say that states may take a different view than the U.S. Department of Labor with respect to volunteers. So just kind of as a recap of this, volunteers are generally not considered employees under the FLSA and therefore would not be covered under the FLSA. Their activities don't bring them under enterprise coverage, but where employers can get into trouble is where they are using volunteers as an employee, and the person is in fact an employee, even if they're a part-time employee who needs to be compensated for their time. Next slide, please. So I just wanted to mention, kind of in closing before we get to our takeaways, that just be aware that there are sometimes state rules and laws that apply differently to nonprofits. Maybe a frequency of pay requirement could be different. For instance, in New York, manual workers need to be paid weekly, but nonprofit manual workers can be paid biweekly. Unemployment insurance and workers' comp laws may apply differently to nonprofit organizations, or certain employees may not even be considered employees for unemployment and workers' compensation coverage purposes, like a minister in a church or a caretaker at a church, other things like that. So just be aware of that. And states may just have special types of rules and exceptions for nonprofits. In New York, for instance, a newly formed nonprofit within 6 months of formation can elect to be exempt from coverage under a minimum wage order, meaning that they don't need to pay overtime under New York's labor law, so long as they're meeting statutory minimum wage. Although, theoretically, if you had a nonprofit that transacted business in New York, didn't meet the threshold for FLSA enterprise, none of its employees were individually covered and only covered by New York labor law, they could theoretically not have to pay overtime to the non-exempt workers. That said, it's pretty easy to find individual coverage under the FLSA, but it's just something to be aware of, that the states in which you operate may have special rules for nonprofits. Next slide, please. And so now we just have a few takeaways from our presentation. Next slide, please. So first, review your budgets to make sure and incorporate these changes, the final rule that took effect on July 1st, to make sure that you know that you're going to be able to afford to raise the salary threshold to keep your employees as exempt. What's going to be the impact in terms of reclassifying employees as non-exempt and taking into account the overtime that may be anticipated for those employees. Determine whether reclassification from exempt to non-exempt is warranted. And when you do that inquiry, do that with your legal counsel to ensure that you have a privilege that's protected in those deliberations. So the privilege that exists between you and your attorney. If your attorney is not included, then those deliberations could be discoverable in a litigation. Train HR and hiring managers on the impact of the final rule, and also on who's a volunteer and what does it mean to be a volunteer, to make sure that you're not running afoul of a situation where your staff is using volunteers in a way that they should not be used. There are record keeping obligations under the FLSA, and also there may be under your state labor laws as well. So you want to make sure that you're aware of those record keeping obligations with respect to the hours worked, time that's taken for meal breaks, the time that a person returns to work, and that you're that you're tracking that. Review and update your employee policies regarding timekeeping, regarding classification. It's a good idea to review the job descriptions annually for your employees to make sure that they are doing the work that's in the job description, or updating it to reflect the work that is being done, so you can confirm that your classification of them as exempt is accurate or non-exempt. And if you have volunteers, it's a good idea to have a written agreement with the volunteer that sets out that there's no expectation of compensation, that no compensation will be received, and that the understanding is crystal clear. And conduct pay equity audits to ensure that there is no disparity based on a person's legally protected category, whether it's their race or sex or other legally protected category. Make sure that people that are performing the same job with same experience are being paid fairly. And with that, I will turn to the next slide, and David will take that takeaway.
Thanks, Lisa. The top line takeaway from this slide and sort of that first bullet point there is just to be proactive in looking at these issues, and as Lisa mentioned, periodically assessing whether or not you feel you're comfortable with the way that your employees have been classified in terms of the exempt versus non-exempt status. Classifying an employee as exempt if they don't meet the qualifications for the exemption can carry with it significant liability. That can manifest itself in a scenario where the employees left the organization and then they come back and say, well, I think I was misclassified. I should have been getting paid overtime while I was employed. And at that point, the court would essentially take a retroactive look based upon the nature of what the employee's job was and what they were doing as to whether they in fact met the requirements for exempt status. And if the employee shows that they didn't meet those requirements, then they're entitled to payment for any overtime hours that they worked while they were employed. And that can create a very difficult situation for an employer, because most employers don't track the hours worked by their exempt employees. So if someone is found after the fact to have been non-exempt and they say, well, I was working 50 hours every week, if the employer doesn't have time records or any documentation to refute that, it can create a very difficult issue in terms of proving, well, was the employee actually working overtime or not? And just to sort of further make that point, in addition to compensation for any unpaid overtime hours, in that type of litigation, the employee can also recover liquidated damages. They can be awarded any attorney's fees that they incurred in bringing their claim if they're successful. So the scale of the risk can add up very quickly. The second point on the slide here, just avoiding some of the common wage and hour mistakes. As I mentioned earlier, kind of a big point to carry away from this is that paying someone a salary by itself doesn't make the employee exempt. You also need to make sure, number one, that they're paid at a salary rate that exceeds the threshold that applies, but then also that they meet the requirements of the duties test for the particular exemption that you're relying upon with regard to that employee. Another takeaway, just to reinforce what we talked about, make sure you're aware of the laws of the states where you have employees. If you have employees in a number of states, which is certainly more common in this era of remote work, you need to make sure that you're complying with the laws of any state when it comes to the employees who are working in that particular jurisdiction. And as we discussed earlier, some states have different salary thresholds for the exemptions under their own state laws. And then just another point there, just to sort of follow through on that, is that some states in their own wage and hour laws don't recognize all of the exemptions that are contained in the FLSA. So if you're relying on some particular exemption that's in the FLSA, you need to make sure that that's also recognized under the law of the state where your employee is working, so that you're covered both from a state law and a federal law perspective. And then the last point there about adjustments for government contracts, there's kind of two angles to that. One is making sure that if you have a government contract, that you're following the letter of it if it requires that employees be paid at some heightened compensation level. For example, if there's some living wage requirement in there, it may go beyond your sort of typical FLSA baseline. But then also just in terms of making sure that if you've got one of those contracts, that you are in fact, again, budgeting and sort of making sure that if it requires some particular rate, that you're doing what you need to do to make sure that you can account for example, changes in the FLSA salary threshold that then may require you to pay those employees more than what you may have thought at the outset. If we can go to the next slide, just a final note here, we have included a link to one of the Department of Labor's guidance publications with respect to nonprofit issues arising under the FLSA. That's a helpful document that kind of contains some summary information that touches on a number of the issues that we've talked about today. And so with that, I believe we've reached the end of our prepared remarks, and we can see if we can open the floor to any questions.
David, there's just one.
David and Lisa.
I'm sorry, I was just going to just make one last point to follow up on David's point about exemptions, and that the state exemptions may not necessarily always track the federal exemption. So for instance, in New York does not recognize the highly compensated exemption. So I just wanted to give kind of a specific example with respect to David's point. That's all I have on that.
Okay, thanks. We've got a number of questions come in. Some are similar, so if I don't read your question exactly, it's because it is similar to someone else's. The first question is for David. When we're considering compensation, do we include bonuses that are projected for the end of year, or is it strictly based on salary?
So when it comes to those white collar exemptions, the regulations that deal with the salary basis test do provide that an employer can comply with that by paying up to 10% of the required amount in the form of a non-discretionary bonus or incentive. And so if that component is utilized, it does have to be paid on at least an annual basis. And then if the employee leaves during the year, whether they're fired or resigned, they have to be paid at least the prorated portion of whatever that amount would have been. So the short answer there is that non-discretionary bonuses can be considered there, but they are subject to that 10% cap. And again, you would want to make sure that you're looking to see whether the state that the employee is working in similarly recognizes that rule for purposes of its own state law requirements.
And so that cap, just to clarify that, so that cap for the person asking the question, that cap is $84.40, since the weekly wage we're talking about now as of July 1st is $8.44 a week for exemption. So I just wanted to clarify what that means, that cap is.
Great. Okay. The next question, Lisa, is for you, and that's with respect to the tax status of the employer, and does that make a difference? Our audience has both 501c3 charities and 501c6 trade associations and professional societies, and we got that question from one of each.
Yeah, the Department of Labor's guidance seems geared to 501c3s and hasn't specifically addressed that or said that there is a distinction either way.
Okay. Next question. Is there I guess it's for David. Is there a standard calculation to convert someone from exempt to non-exempt?
So if you're converting from exempt to non-exempt, again, once somebody has become non-exempt, you're only then looking at paying them at least the minimum wage and then paying them overtime for any hours over 40. And so if you had somebody who, just to take an example, you were paying a salary of $40,000 to, and now because the salary threshold has risen for exempt status, you've decided, well, we're going to convert this person to non-exempt, you could still keep their salary level the same, but then you're needing to, number one, track their time to be able to figure out, okay, are they exceeding 40 hours? And if they are, you then need to pay them that time and a half overtime premium for any hours above 40. And I will just say is sort of a word of caution that conversion from exempt status to non-exempt status can be somewhat fraught in that, you know, it's relatively straightforward. For example, let's say you got to December 31st of this year when the new salary threshold is going to kick in, and you decide, well, we're not going to bump this person up to the new level, and therefore effective January 1st, we're going to convert them to non-exempt. You've kind of got a clear threshold and a reason why you're doing that. Whereas if you, in a more general context, sort of look and realize, well, based on this person's duties, they don't qualify for exempt status, we think we've maybe misclassified them, I would say you're going to want to consult with legal counsel about how to manage that, because if you go to an employee and say, well, we've decided you are no longer exempt, going forward, you're going to be paid overtime when you go over 40, that's very likely going to give rise to a question from that employee of, well, should I have been getting paid overtime all along? What about the preceding period? And that can get you into some fairly thorny issues about, well, how do we address it if we think that the person has been working some amount of overtime? And how do we sort of effectively communicate that to hopefully address the issue in a way that's not going to give rise to a claim?
Thank you. We have run out of time. So for the rest of the questions, I'm afraid we're not going to be able to answer those.
But we're happy to answer your questions. If you'd like to follow up, you can email us with any questions that you may have that we didn't get to today.
Thank you, Lisa, David, and Eileen, and thank you everyone for attending today's webinar. Just a reminder that you will receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar, as well as a copy of the slides. Please feel free to reach out to today's presenters on any questions that weren't answered. On behalf of Whiteford and our presenters, thank you for joining us and have a great rest of your day.
Thanks, everyone.
Thank you all.